Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
Today, we're really getting into a foundational paper in finance, specifically around private debt contracting.
Yeah, this one really makes you rethink how these deals are put together.
It's Valeri Nikolaev's 2018 paper, Scope for Renegotiation in Private Debt Contracts, from the Journal of Accounting and Economics. And it's not just about the fine print.
Not at all. It digs into the sort of hidden governance role that debt contracts play.
The core question the paper tackles, what is it exactly?
Well, it asks something fundamental. Does the basic need for a lender to monitor a borrower actually drive how often, how intensely they end up renegotiating the debt contract later on?
Right, so it's looking beyond just whether a contract gets renegotiated to how frequently it happens.
Exactly. It moves past thinking of contracts as just these rigid things.
And the paper zeroes in on this key tension, this trade-off. Can you unpack that a bit?
Sure. On one hand, you've got the benefits. More monitoring by the lender can keep management focused, aligned. That's good.
Yeah.
But on the other hand, too much intervention, too much lender control can actually stifle the business. That's the holdup problem. Lenders might push for short-term safety over long-term growth.
Okay, so it's this balancing act right from the start, baked into the contract design. Let's frame this up a bit more. What was the paper's main mission, and what did it find?
The mission was really to test empirically if these upfront issues, agency problems, information gaps actually predict the intensity of renegotiation. Not just if it happens, but how often.
And the method they used was pretty impressive, wasn't it?
Oh, yeah. It was massive. They pulled data on over 92,000 actual debt contract modifications, amendments, waivers, you name it, from SEC filings.
Wow.
And they linked that to CompuStat and DealScan data. The key was focusing on renegotiation intensity. So how many times per year or how short the gap was between these events.
Capturing the pulse of that relationship.
Exactly. And the main finding, yes, absolutely. The need for monitoring does predict intensity.
So firms that, let's say, look riskier or harder to track.
They see more frequent renegotiations. Things like being financially constrained that was positively linked to higher intensity.
And the flip side, the holdup costs.
Also confirmed. Firms with lots of growth opportunities or heavy R&D where manager flexibility is crucial and holdup risk is high, they tend to have less intense renegotiation patterns.
They structure the contracts to avoid that interference.
Precisely. So the big contribution is showing this with large-scale data from an ex-ante perspective, looking at the firm's characteristics before the renegotiation. And it shows that things like covenants aren't just safety nets. They're often set up as triggers for these renegotiations.
That really changes the game for managers, doesn't it? Especially in those high-growth sectors.
It totally does, because if you just see renegotiation as fixing something broken, you're missing the strategic element.
Right.
The paper argues it's a feature, not a bug. It's a way for lenders to participate in governance, influence decisions, get information.
So for a CFO, designing that contract means thinking ahead about this balance.
Absolutely. How much access to capital do we need versus how much potential interference can we tolerate? It's a calculated risk, especially if you're investing heavily in long-term, maybe intangible projects.
Okay, let's nail down some key terms then. You mentioned renegotiation intensity. Just to be crystal clear, that's about frequency, right? Like events per year or time between events.
Exactly. It's not just the total count over the loan's life. It's about how often those interactions are happening.
Got it. And this all ties back to incomplete contract theory, you said.
Yeah. The idea that you just can't write a contract that covers every possible future event. That incompleteness comes from two places.
Okay.
First, there's just random uncertainty, market shocks, stuff happens. That's like the external trigger. But second, and this is the paper's focus, there are the internal predictable issues, agency problems, information asymmetry. We know managers might pursue their own goals, and we can't perfectly write rules to prevent that ex ante.
So renegotiation becomes the way to deal with those foreseen but non-contractable issues.
Right, which leads us back to that core trade-off.
Let's define those two sides clearly.
Okay, so you have the monitoring hypothesis. That's the benefit side. More agency conflict means you need more monitoring, and frequent renegotiation is the tool for that. It helps the lender check in, get information.
Makes sense.
Then you have the investment efficiency hypothesis. That's the cost side. Too much renegotiation, too much potential for lender interference or holdup could scare managers away from valuable long-term projects, especially intangible ones.
So the contract tries to find the sweet spot between those.
Exactly. And that ties into the strategic view of control rights. The idea here is that things like financial covenants, say, a debt-to-equity ratio limit, aren't just arbitrary limits. They might be set intentionally tight.
Intentionally tight. Why?
To act as tripwires, basically. They serve as pre-agreed points where the lender gets to step back in and reassess things, forcing a renegotiation to address potential agency issues that might be brewing.
Okay, that foundation is really helpful. Let's use that to dive into our 6 core questions about the paper. First one, what exactly is the research question and why does it matter so much?
So, restated, the research question is, does the intensity of private debt renegotiation vary predictably based on that X anti-demand for monitoring, reflecting that trade-off between monitoring benefits and intervention costs?
Okay, and the importance.
It's important because it kind of revisits and refines earlier findings. Some prior work, like Roberts and Sufi, looked at whether renegotiation happened at all and found it wasn't very predictable based on initial firm characteristics. But Nikolaev shows, well, maybe the occurrence is noisy, but the intensity, how often it happens, is predictable. That's a big deal because it connects contract design much more tightly to agency theory and the lender's governance role. It suggests the design is more deliberate than we thought.
Interesting. So if the design is deliberate, what theories are underpinning the hypotheses? That's our second question. Where did they draw these ideas from?
They're really standing on the shoulders of giants here, heavily relying on incomplete contract theory like we discussed, but also the classic agency literature, Jensen and Meckling, for example, and work on financial intermediation and delegated monitoring like Diamond or FAMA.
So established frameworks.
Definitely.
Yeah.
The hypotheses come straight from that theoretical trade-off we keep mentioning. The monitoring hypothesis draws on the idea of the lender needing to step in to discipline managers or uncover hidden information.
Right.
And the investment efficiency hypothesis draws on theories about how hold-up risk, especially with specific or intangible assets, can distort investment decisions. It's about protecting those growth options.
Okay, now for the nuts and bolts.
Yeah.
Question 3. How did the research design tackle validity? Things like making sure they're measuring the right concepts, dealing with endogeneity, ensuring the results aren't just statistical flukes, and whether they apply more broadly. This is always tricky.
Very tricky, especially here. For construct validity, measuring the right thing, they used multiple proxies for the key unobservable ideas. For monitoring demand, they didn't just rely on one measure. They used indices like the KZ index, the WW index, the RZ index, common proxies for financial constraints.
Standard measures.
Right. And they also used audit premium, arguing higher fees might reflect higher perceived risk or complexity needing more scrutiny. For monitoring costs or hold-up risk, they used market-to-book ratios and R&D spending proxies for growth options and intangibles. Using multiple indicators strengthens the confidence that they're capturing the underlying concepts.
That makes sense. But what about endogeneity, the classic chicken and egg problem? Maybe the renegotiation isn't caused by the firm's initial risk, but by some new information that triggers both the renegotiation and changes the risk measures.
That's the critical challenge for internal validity. Their main strategy was timing. They lagged all those firm characteristic variables, the KZ index, MB ratio, R&D by at least a year, often 18 months, before the renegotiation event.
Okay, so they're measuring the firm's state well before the renegotiation happens.
Exactly. The idea is to capture the pre-existing conditions that likely shaped the contract's design in the first place, rather than capturing information that only emerged right before the renegotiation. It helps mitigate that concern that they're just measuring the outcome, not the cause.
And external validity. How generalizable are these findings?
That's where the massive sample size comes in. Using essentially the whole population of SEC-filed renegotiations over 92,000 events avoids the selection bias you might get from smaller samples based on, say, just press releases. It makes the findings feel much more robust and broadly applicable to publicly traded firms with private debt.
All right, let's move to the econometrics question 4. We've got count data, number of events, and duration data, time between events. What statistical methods did they use, and why were those particular models the right choice?
Good question. Standard regression techniques don't work well here. For the firm-level analysis, looking at the frequency or count of renegotiations per firm year, they used a negative binomial regression.
Why that one specifically?
Because count data often exhibits over-dispersion, meaning the variance is much larger than the mean, which violates assumptions of simpler models like Poisson regression. Negative binomial models are specifically designed to handle that over-dispersion, giving you more reliable estimates when you're counting events that cluster like this.
Okay, so it fits the nature of the data. Some firms have zero renegotiations, some have many.
Precisely. Then, for the contract-level analysis, looking at the duration or time until the next renegotiation, they used a Cox proportional hazard model.
Hazard model. Sounds ominous.
Huh. Yeah, the term comes from survival analysis. Think of the hazard rate as the instantaneous risk of an event happening, in this case, a renegotiation. A higher hazard rate means a shorter expected time until the next event, which signifies higher intensity.
So it directly measures that time dimension.
Exactly, and it's semi-parametric, meaning it makes fewer assumptions about the underlying distribution of time, which adds flexibility. It also naturally handles the finding that having renegotiated recently strongly predicts renegotiating again soon, that dependence over time.
Which brings us neatly to question 5. What were the main results? Did they actually find support for that central trade-off and answer the research question?
Yes, resoundingly so. The results consistently supported the trade-off across both the frequency and duration models.
Okay, give us the highlights, the monitoring demand side first.
Definitely a strong positive link. Firms identified as more financially constrained using the KZ index, for example, showed significantly higher renegotiation intensity. The paper quantifies this, moving from the 25th percentile to the 75th percentile in terms of financial constraints. KZ rank was associated with about a 49% higher likelihood of renegotiation.
Wow, nearly 50% higher intensity just based on being more constrained beforehand. That's substantial.
It really is. And using the audit premium proxy yielded similar positive results, around a 21–22% increase associated with higher residual audit fees. It suggests lenders really do step up monitoring via renegotiation when perceived risk is higher.
And the other side of the coin, the hold-up costs, the investment efficiency hypothesis.
That showed up clearly, too, with a negative link. Firms with high market-to-book ratios, proxying for growth options, and high R&D intensity consistently showed lower renegotiation intensity.
So managers of these firms seem to successfully negotiate contracts that give them more breathing room.
That's the interpretation. They seem to trade off potentially tighter monitoring for protection against costly interference that could derail their intangible long-term investments.
Did they look at specific contract terms too?
Yes, and that supported the strategic view of control rights. Things like secured debt, borrowing base provisions, restrictions on capital expenditures or dividends, and most financial covenants were associated with higher renegotiation intensity.
Acting as those triggers we talked about.
Exactly. The one interesting exception was performance pricing provisions in loans. That was negatively associated with intensity, suggesting it acts as a substitute. The interest rate adjusts automatically based on performance, reducing the need for frequent formal renegotiations.
All right, final core question number 6. What are the main conclusions the authors draw, and do you think they're truly warranted based on everything, the theory, the design, the results?
The main conclusion is clear and I think very well supported. They conclude that renegotiation isn't just an afterthought or a sign of failure. It's an integral, deliberately designed part of the private debt monitoring process. The intensity of this process is shaped ex ante by that fundamental trade-off between the benefits of monitoring and the costs of potential holdup.
You feel the evidence backs that up solidly.
I do. The conclusion seems warranted because the core results are robust. They hold up whether you measure intensity by frequency or duration, whether you proxy monitoring demand with financial constraints or audit fees, and they control for a host of other factors.
The consistency across different approaches helps.
Absolutely. And they added another layer of validation by looking at the market reaction. They found that these renegotiation announcements are associated with a small but statistically significant positive stock price reaction, about 30 basis points over 5 days, and significant spikes in trading volume and volatility around the announcement date.
What does that market reaction tell us?
It suggests the market views these renegotiations, on average, as positive news. It implies that valuable, private information is being revealed or certified through the lender's involvement during the renegotiation, aligning with the idea of the lender acting as an informed monitor. It sort of triangulates the whole story.
Okay, wrapping up then. How does this paper connect to broader themes in finance and accounting?
Well, it really pushes the theory of financial contracting forward. It reframes how we think about covenants, not just as static constraints, but as dynamic triggers for governance.
Less like walls, more like doorways for discussion.
Kind of, yeah. It strongly reinforces the idea of the lender as a delegated monitor, someone who gathers and certifies information that the broader market can't easily access. But it shows this happening continuously through renegotiation, not just at loan origination.
That dynamic view is powerful. And I wanted to leave our listeners with a final thought, stemming from a specific part of the paper, their analysis on outside opportunities.
Ah, yes, that section was quite revealing about the holdup costs.
It really was. They found something perhaps counterintuitive at first. When a borrower's bargaining power seemed weak, maybe because they were physically close to their main lender, who likely had lots of soft information, or during a credit crisis when alternative funding dried up, the intensity of renegotiation actually went down.
Right, less frequent renegotiation when the borrower seems cornered.
Why? The interpretation is that the lender, knowing they have the upper hand, can extract more concessions or rents if a renegotiation happens.
So the borrower, anticipating being held up,
It strategically avoids triggering that renegotiation unless it's absolutely unavoidable. They might delay necessary changes because the cost of asking the lender is too high.
it's a stark illustration of the holdup cost in action.
Exactly. So the provocative thought for you, the listener, is this. If weak outside options can lead borrowers to postpone potentially value-enhancing adjustments simply to avoid lender holdup, how should firms proactively manage their lender relationships and their perceived access to alternative financing from the outset? It suggests that maintaining credible outside options isn't just about getting a good initial rate, it's crucial for maintaining operational flexibility throughout the life of the loan.
Something critical to consider when choosing your financing partners and structuring those deals.
Indeed. Fascinating stuff. We'll see you next time on The Deep Dive.
Thanks for tuning in to the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.